This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, I'll be giving you a portfolio update for the month of February 2022 on my Sharesies public portfolio. So a lot of market volatility during this month of investing, as well as that some of the companies within the portfolio have reported their results. So some of the big hitters like Heartland Group Holdings and Scentre Group, as well as Kogan, which is quickly becoming a problem child for the portfolio. So I'll show you later in a few seconds. As always, none of this is financial advice. You should always do your own research before investing. So with that out of the way, let's get right into the video. So over here, my portfolio is sitting at $23,358, and the simple return is currently at 10.47%. Now I have a cash position that I haven't invested, and that is $171.97. In terms of the positions, nothing has changed. I still own the same 8 stocks, that is Auckland International Airport, Collins Foods Limited, Heartland Group Holdings, Infratil, Kogan, Macquarie Group Limited, Oceania Healthcare, and Scentre Group. So as you can see, Kogan is now the largest loss position in the portfolio, and that is at a loss of close to 48%. So you can see why it's quickly becoming a problem child for the portfolio. Fortunately though, Kogan is currently one of the smallest positions in the portfolio. However, the same can't be said about Oceania Healthcare, which was the largest position, and I think Scentre Group has taken over as the largest position now. But Oceania Healthcare, in my opinion, is a fundamentally less risky company than Kogan is. Therefore, I'm comfortable allocating a larger amount of the portfolio. About 24% of the portfolio now is invested in Oceania Healthcare. So now let's take a look at the ShareSite dashboard, which shows us how the portfolio has performed against the benchmark. And as you can see, since inception, since the first time I've bought any shares on the Sharesies portfolio, you can see that the alpha, or the difference between the performance of the portfolio versus the ETF, has narrowed significantly. But over the past month, that drop has sort of been stabilized. So you can see that the portfolio has returned a negative 1.38% versus the FNZ ETF. So that loss hasn't been as big as what it was in January. However, there's still a minor underperformance of the portfolio. So as you can see over here, most of the underperformance is coming from Oceania Healthcare, and that is down 11% over the past month. There hasn't been any news from Oceania Healthcare, but the only reason I can think of is because of the virus. It's increasing labor costs significantly. It's reducing the number of employees or nurses that can come into New Zealand. And as well as that, there's a lot of wage pressure and a lot of labor cost pressure in the building side of things as well. And I think the market is pricing that accordingly, as well as that house price indexes have been indicating that house prices has already topped out, and we might see a decline in 2022. So all of those fears are playing out into Oceania's share price, and we can see that down 11%. Now I want to show you another report over here, which is the All Trades report. So as you can see, the only stocks that I've bought were Macquarie Group, and I bought a few shares, 1.47 shares. And that was for a value of $280. So at the moment, there's no cash in the portfolio. It's fully invested. Every week, I top up $70 into the portfolio to invest. At the time when I made that rule of $70 per week, the portfolio was much smaller, so it actually made a larger percent of the total portfolio. However, now since the portfolio is at $23,000, $70 a week is not significant in the grand scheme of things. In order to fund new positions, the only way to do that is to sell existing positions to raise the cash and then buy the new positions. If you're interested in using ShareSite to track your portfolio performance, and as well as that, it also helps you calculate your taxes, which is very important because, as you know, tax time is coming up soon. By the end of this month, you will be able to report your taxable income for 2022. So if you're interested, I have a link down below for ShareSite. You get 4 months for free when you sign up with a yearly plan using my link below. So check that out. So now let's talk about some of the results that have been released from the companies. So the first one that I wanted to talk about is Scentre Group. Now, Scentre Group had reported their results on the 23rd of Feb, and on the day of reporting their results, the share price slipped 4.43%. But before that, they had a huge rally on the back of a competitor Vicinity's earnings results, and their results was very good, which meant that Scentre Group also benefited being in a similar industry. However, when they reported their results, they slipped 4.43%. So let's take a look at why this is the case and whether we need to be worried about this. So here are the highlights, the high-level earnings results. So you can see Scentre Group reported 2.6 billion in gross cash receipt, a growth of 13.7%. Net operating cash flow up close to 25%. Operating profit 10.9%. Funds from operation 12.7%, and distributions for the year, or in other words, a dividend to shareholders, has increased by 103%. So these metrics show good growth year on year. In addition to that, it's important to note that 2021 still had quite a bit of disruption from lockdowns. So it's good to see that people are going back to shopping malls, people are spending after these lockdown periods, and we can see that in the results. Now, in terms of why I think the market was slightly disappointed, had to do with the revaluation. In December 2020, the net balance sheet assets per security was $3.63. So that's the NTA number. If the company liquidated, sold all its assets, paid off all its debt, they'll be able to get back, $3.63 per security. And that's increased to $3.66 per security. So that's just a 3-cent increase. I think this small increase was a bit disappointing for shareholders. I was expecting a higher revaluation from Scentre Group given how we've already moved past COVID. So COVID had an impact on the valuation of the property. So as we move out of lockdown, the logical conclusion is that the net tangible assets should go up based on increased cash flow. However, management did say on their conference call that they are a bit conservative with their cash flow assumptions. Therefore, the net balance sheet assets will be deferred. The increase in the NTA will be deferred to future periods. So I think that shook the markets a little bit, but in my opinion, this just needs a little bit of time, and it will slowly adjust to above $4 as it was before COVID. Now, in terms of the outlook, this was very confusing as well. It said that subject to no material change in conditions, the group expects to distribute at least 15 cents per security for 2022, representing at least 5.3% growth. Earnings are expected to grow at a higher rate in 2022. It looks to me that the management team was very conservative in their forward guidance, and in the market that we're currently in, a weak guidance will be severely punished. In my opinion, the guidance could be easily beatable given that Australian COVID cases have already hit the peak, and cases in New Zealand will hit the peak this month. The sell down should provide a great opportunity to add at the current low prices. In my opinion, the stock has a fair value of $4 per security that can be reached within the next year and a half. Alright, so now let's talk about Heartland Group Holdings. Heartland Group's share price has dropped 6.2% this past month, and they reported their results as well. So let's take a look at their results. So over here we see net profit after tax of 47.5 million, which is up 7.8% over the first half of the year. Other things to note as well is that net interest margin at 4.3%, up 3 basis points, which is great. Cost to income ratio down 5 percentage points, which is also good. But impairment expense ratio has increased by 13 basis points to 0.33%. So on a high level, there was nothing, concerning about Heartland Group's results. One thing that stood out to me was that strong asset growth has been received, though in second half of 2022, growth is expected to slow in motor and online home loans as a result of CCCFA, or the Triple CFA impact. So in case you don't know, the Triple CFA is the Credit Contracts and Consumer Finance Act, and some changes were made from 1st of December to aim to protect consumers from unaffordable debt, requiring lenders to ensure loans are suitable and affordable. However, the level of evidence required around affordability has increased and has been labeled as overly prescriptive, and meant bank statements were put under the microscope. So banks, as a result of the changes in this Triple CFA, had made debt a lot harder to obtain from households. So that is one of the reasons why we see house prices in New Zealand starting to decline is because a lot of first home buyers can't get financing, and the same impact as well for Heartland Group's financing home loans division and motor division as well. So that will reduce asset growth going into the second half of the year, and that will impact obviously how much profit they make. Another headwind to profit for Heartland Group is that they are focusing on moving towards higher quality and lower risk assets, which is expected to impact NIM, net interest margin, in the second half of 2022. However, will be mitigated as operational efficiency and asset quality continue to improve. So hopefully this will lead to a lower default rate, a lower impairment ratio, which is what we've seen increase this half year, but this will impact NIM in the short term. So these are some of the headwinds that Heartland Group is facing, and they expect that net profit for 2022 to be in the range of 93 to 96 million, which is what they previously guided for at the previous update. The market usually expects to see Heartland Group upgrade their profit because that's what we've been used to in the past. However, this time around, because of changes in the CCCFA, that hasn't been the case over here. Now, in terms of Heartland, where they currently trade at $2.27, I've calculated that the forward dividend yield on a gross basis is about 8%. So I'm holding Heartland Group as a dividend play at the moment. Personally, I don't see much capital appreciation from here, given that they've already guided for their net profit, and that net profit figure, from my opinion, won't be upgraded during the year due to headwinds that they're facing. So in terms of capital gains, there won't be much upside from here. However, I do think that holding for dividend yield also makes sense. I wouldn't be adding more into my Heartland position, given that it's already one of the largest positions in the portfolio as well. However, I do have to say that they have one tailwind going for it, and that is interest rates going up. Now, this article over here basically says that markets need to brace for unprecedented 10 rate hikes in a row. So based on inflation numbers and based on the commentary from the RBNZ in New Zealand, it seems that the RBNZ will increase rates 10 times in a row, each time 25 basis points. So that is basically a 2.5% increase over the next 10 meetings. So that will be a tailwind for Heartland Group Holdings, expanding their NIM, their net interest margin, and that should cushion some of the headwinds from the CCCFA and the shift towards higher quality assets. So I continue to hold Heartland Group Holdings, but I won't be adding more to my current position. So now the last position that we'll talk about is Kogan. So Kogan has fallen from a high of about $25 per share. Now it's down 77.8%, and the past results in the past month hasn't been that great for Kogan as well. The share price has dipped quite significantly, as you can see over here. So now let's talk about the results. At a high level view, it's not great. So accounting profit has dropped from 23.6 million in the first half of 2021 to a loss of 11.9 million. So that is a huge drop in profit. However, adjusted profit is in the positive, but that's still down 30.6%. So obviously Kogan didn't have the best first half result. However, there are a few good things about this result, in my opinion. The first one is that they generated positive free cash flow. So net cash from operating activities was 61.7 million, and they've spent about 30 million paying off the Mighty Ape transaction, and they also paid another 54 million off in loans and borrowings, as well as lease liabilities. So they've used free cash flow to pay down debt, which is great, and now they have a cash balance at the end of the half year at about $70 million. And we've also seen inventory come down a little bit from 227.9 million to $196.8 million. So this is a good sign. It shows that the business is kind of resetting the inventory position, and now they are focusing on growing revenues going forward. So this is an interesting time for Kogan. Obviously very difficult to see where future earnings will go and where future revenues will go, future margins, and it's very hard to determine the value of the business. However, as I said, Kogan's already dropped from $25 to where it is currently, and in my opinion, that is fully appreciating what's happened to the business. It's done really well, but at the same time, it got up to a point where they're not making any profit on their sales. So this gives Kogan a very good position to reset their strategy, to move on from the losses that they shouldn't have needed to incur in 2020 and 2021. So personally, I've decided to hold Kogan in the Shares Public portfolio, even though the optics around it is not great. Obviously, that's the largest loss position. And if I think about the current share price at around $5, if it goes back to $10, that's a 100% return, right? So even though I've lost, over 40% on that position, if I were to invest new money into a new portfolio, Kogan could potentially be my speculative play, given that they've resetted their strategy on their inventory, and now that they're focusing on building that loyalty, that customer loyalty, especially around Kogan memberships, I think that can drive potential growth. So we'll see how the rest of the second half year play out, and that could potentially be good for Kogan. So I'm willing to hold them for another half year and potentially even longer than that if the strategy executes well. And remember, Kogan is one of the top shorted stocks on the ASX. Currently, the short positions are 10.67%. So this is nothing new. Kogan has been a heavily shorted stock, but one day the shorts will have to cover, and that is why we might see occasionally Kogan, increasing by between 6 and 10%. So that's all for today's update. Hopefully you guys enjoyed it. If you did, be sure to leave a comment down below and like the video and subscribe. And if you haven't already, check out ShareSite, link in the description. Sign up, get 4 months free on a yearly plan. So thank you guys all for watching. Until next time, take care.